So my name is Alex. I am the product manager / bookkeeping services manager here at Aplos. I have been around for a while and done a number of things, but kind of spent most of my tenure heading up our customer service department. So training a lot of customers on what accounting is, how to use our software, and then how to kind of tailor that to their organization and achieve their goals accounting-wise. More recently, I'm heading up our new bookkeeping services department as well. So that is kind of my new venture. But part of my job description is every so often I get to host these webinars and talk about accounting stuff. So if you guys have been to another webinar from us, Dan Kimball likes to talk about all of the fun topics like how to get your board to get you more money or how to fundraise. I get all of the back office stuff, which is all the accounting things. So those of you in the room are most likely my kind of people, the ones dealing with the accounting side of things. So I definitely understand that this is going to be a little bit more heady of a subject, but hopefully I'll do my best to make things simple and understandable for everybody. So here's a little intro. So most churches have at least a few fixed assets they need to track in their accounting. So whether you're a large church or a small church or a nonprofit, it is important to know the requirements for tracking your fixed assets and depreciation. Tracking these accurately is essential for good stewardship and accountability. So you guys know, with any church or nonprofit, you need to keep track of your money, your debt, your income, and your expenses, as well as all of your other possessions. So not just your bank accounts, but your investments, your savings, your accounts receivable, your pledges, as well as these things called fixed assets. So a fixed asset essentially is, we're going to cover this in a minute, but it's a tangible item most of the time that it brings some sort of value to your organization, but that's not cash. Okay. So today we're going to take a look at what is a fixed asset, what are the fundamentals of a fixed asset, how do you calculate and compare different methods of depreciation for those fixed assets, how do you allocate fixed asset costs according to GAAP standards? How do you maintain a record of depreciation for each fixed asset? And then how software can help you track these fixed assets. All right. So what is an asset versus a fixed asset? An asset in accounting, there's 5 different types of accounts: assets, liabilities, equity, income, and expenses. Assets are things that you own. They are possessions of your organization or you personally in your own finances. Your assets are the things that you as an individual own. So your house, a car, television, the money in your bank account, that kind of thing. So for a church, assets, same deal. Money in your bank account, buildings, cars, equipment, accounts receivable, all of those things that you own are considered assets. A fixed asset is typically an item that's over a certain value that you want to spread the cost of the item out over multiple periods or multiple years. Okay. So a fixed asset brings value to your organization and the cost is spread over its normal life. So, for instance, let's say you go to the store and you buy office supplies. Okay. So you buy pens and paper and staples and all kinds of office supplies. That expense that you incur, say it's $100, you record that expense for when you purchased it. So it's October. I purchased it in October. It counts as an expense for October. But let's say if I wanted to purchase a new soundboard for the audiovisual department. Okay. So I'm going to purchase a soundboard. That soundboard might be $8,000. Okay. So what I don't want to see is $8,000 worth of expenses on my October 2016 income statement because it's a lot. And the item is going to be used over a longer period of time. It's not really disposable. It's not temporal. It's something that actually has value and it's gonna bring value to your organization over a long period of time. So that is essentially what a fixed asset is it's something that's over a certain threshold of cost that will be spread out over a longer period of time that brings value to your organization. So let's take a look at that. So a fixed asset, a long-term or relatively permanent tangible asset such as equipment, machinery, or buildings that are used in normal business operations and that depreciate over time, meaning depreciation, meaning it has a value and it's kind of decreasing in value over time. And we're going to take a look at all of this here in just a minute. So some examples of what a category of fixed asset would be. You've got land. Okay, so you own land. You also own buildings. So on the land is a building. So you've got your property, church property, and you've got your sanctuary, your church building. And then you have building improvements. So let's say over a time you add a wing, right? So, well, not a physical wing, but like a rooms kind of wing. You want to add some office space or something. So you build on to the building. That's what's called a building improvement or addition. So those are depreciated separately than the actual building itself. Then you have equipment, like I said, the soundboard or video equipment or really any kind of equipment. And then you've got vehicles. So those are kind of some broad categories of what could be considered a fixed asset. How you decide on what a fixed asset is based on what we call and what accounting calls a capitalization policy. And what this is, it's a determination of whether an item is a fixed asset and made possible if it meets a certain threshold criteria. So the two kind of criteria there is the item has to have a useful life of at least 1 year. So more than 1 year, it's going to be used over more than 1 year, and it costs over a certain threshold that you as an organization kind of decide on. The rules on what the cost threshold is it has to be reasonable. And I know that word is kind of open to interpretation, and I think it's on purpose. Reason being is if the threshold was always $10,000, then a lot of places would never have a fixed asset because you don't purchase anything over $10,000. If it was always $1,000, everything you buy might be a fixed asset, and so that's too much. So it kind of just depends on your organization and what makes sense for you. Just set it as at a reasonable limit. Some examples here. So let's say that your threshold is $3,000. So if you bought a computer for $2,500, then that doesn't meet the $3,000 threshold. So it would just be expensed normally, like office supplies earlier. It would just be expensed in the period where you bought it. But if you bought a computer for $3,500, well, now it's a fixed asset, and now it gets depreciated over time because it met the requirement of your capitalization policy. Along with a capitalization policy, you have what's called a depreciable life policy, which means that once something has met the threshold of capitalization, once something is beyond that threshold that you set, then the depreciable life policy picks up and says, okay, anything over $3,000 is going to be called a fixed asset. The depreciable life policy says once it's a fixed asset, it's going to be depreciated in this method over this period of time. And it depends on what the asset is. So the useful life, the estimated lifespan of a depreciable fixed asset during which it can be expected to contribute to company operations. So these kind of categories here are set through IRS and GAAP. GAAP stands for Generally Accepted Accounting Principles. These year life cycles are kind of set. These are normal broad stroke terms for these types of items. Okay, so buildings are typically depreciated over a 40-year period. Okay, building improvements is spread over the life of the original asset as at a minimum of 20 years. Okay. Furniture and equipment is somewhere between 5 to 10 years, depending on what it is. I mean, if you have a couch for 10 years, good for you. But, that one you might want to keep to 5 years. But if you have, sound equipment, and the sound equipment is, pretty well state of the art and it's going to last for 10 years, then 10 years might be appropriate. Same with computers, 5 years. I've heard of other faster schedules. People want to depreciate their computers over maybe 2 or 3 years. Again, it has to be at least 1 year. But if you want to recycle computers more often, then you can depreciate faster. And then vehicles somewhere between 3 to 5 years. Okay. So the depreciable life policy also says what method of depreciation you're going to use. So it's met a threshold. You're saying, okay, it's a car. We're going to depreciate it over 5 years. And then the method is now, how am I going to depreciate this? Okay. Couple methods. The most straightforward, commonly used, and in a lot of ways, best one, just for simplicity's sake, is what's called straight line depreciation. And what that means is it's just even division. It's saying if there's something that you bought for $25,000 over here on the left, and you're going to depreciate it over 5 years, then it's going to be evenly depreciated over every single year. You basically take 25 and divide it by 5. So $5,000 per year. And then if you want to go monthly, there's a different monthly value, but it's evenly distributed over the period of time. Double declining means that it kind of goes at a more rapidly accelerating pace. So you can see that it's a little bit more sharp of a decline. So you depreciate more in the first couple of years, and then it kind of just evens out and tapers out towards the end. There's some other methods too, but quite honestly, straight line, if you're new to depreciation and you don't really have a reason to do a different kind of depreciation method, then I would just go to straight line. That's the easiest to do. I haven't seen a lot of reasons why it would be anything different. So straight line depreciation. So calculating depreciation value. So here are some terms that are going to come into play here as we're talking about depreciation. So the cost of the asset is what you paid for the asset. So that is like, let's say there's a car for $25,000. That is the cost and the value of the car when you buy it. Okay, so there's your cost. The salvage or residual value is if you have an estimated value of the fixed asset at the end of its useful life. And the useful life is the term that you're spreading out the cost over, right? So let's say $25,000 is the cost of the car. Okay, so there's $25,000 on the left. And you have a salvage value of $5,000, which is you saying at the end of 5 years, I think that this car is going to be worth $5,000. So what I want to do is I want to depreciate all of the value down to the salvage value of $5,000. So that way at the end of the day, end of the day 5 years from now, on my balance sheet, it will still retain a value of $5,000 on my balance sheet. Okay. Book value is the difference between the cost and what's been depreciated. Okay, so the cost of a fixed asset minus the accumulated depreciation is the value, the book value of the asset. So if I bought a car for $25,000 and over a couple of years, I have now depreciated or spread the expense of it over 2 years, and that's got an accumulated depreciation of $10,000. My book value is 25 minus my depreciated 10, so my book value is now $15,000. We're going to look at some examples, and I'll show you what that looks like on your reports. Okay, so here's another example. So here's a vehicle for $10,000. So the $10,000 meets my capitalization policy, so it is now going to be depreciated. So now it's going to be spread out over 5 years using straight line depreciation, which is according to my depreciable life policy. So then here is how it's broken up per year. In year 1, I'm going to depreciate $2,000 total, right? Even division, 10,000 divided by 5, which means 2,000 each year, which comes into 166 and 67 cents ish monthly. Year 2 the same, 3 the same, 4, 5 the same. So at the end of the 5 years, the asset will be fully depreciated, which means you've spread the $10,000 evenly across 5 years, and the book value will be zero because you depreciated the full value. There's no salvage there. So my $10,000 over each year will just be kind of consistently being depreciated and declining in book value. So at the end of the 5 years, it's on the books, it's essentially worth nothing because you've spread the expense out across the whole time. Okay, so when not to depreciate a fixed asset. So when do you not depreciate? You do not depreciate a fixed asset when it reaches the salvage value. So the example, if the $10,000 car from there, right? If I had a salvage value of $500 at the end of the 5 years, what I would do is I depreciate the difference. So I depreciate $9,500 over the 5 years. So at the end of the depreciation cycle, it still retains a book value of $500. So you do not depreciate salvage value. You also stop depreciating once it's been fully depreciated. You can't have more accumulated depreciation than you do total value of the asset. So if it's finished depreciating, don't depreciate anymore. Stop it. You also don't depreciate if the item has been sold or abandoned or destroyed or converted to scrap or converted to personal use. So if I decided to convert that car to just my own personal use, then the organization, the church, would stop depreciating the vehicle. At that point, it's mine personally, and the church would stop depreciating. So So tracking your fixed assets in accounting. So how does this take place in an accounting environment, right? So conceptually, depreciation is you buy an item, it meets its threshold, so you are going to depreciate it. You depreciate it over a certain period of time at a certain schedule, and at the end of the day, it's worth nothing on your books, and you've spread the cost out over multiple periods of time. So how does all of that situation now boil down into how it works in your accounting? Well, the accounts that you're going to need are in a couple different categories here. So first, your assets. In your chart of accounts, you will want to have a cash account, just checking or something, just to show how you paid for the asset, right? So cash account. And then you also want an asset account set up for the fixed asset itself. So if you bought a car, you want a vehicle asset account to track that value of the asset, okay? You also want an asset account for accumulated depreciation. Now, the trick with accumulated depreciation is it's actually a negative or contra asset account. So on your balance sheet and in your books and in your postings, you're actually using the accumulated depreciation asset account at a negative value. Because what happens is on your books, you're going to see that 25,000 is my fixed asset vehicle, but negative 10,000 is my accumulated depreciation. So the net there is my book value, or the net difference between the two, which is $15,000, right? Okay, so there's your asset. So you also want a liability account for any sort of loan or any sort of mortgage or debt that you owe on the fixed asset, if applicable. If you bought it cash, don't worry about that. But let's say if you bought a building, right? If you bought a building and you put a down payment on and you still owe an amount on the building, you will want an asset account for the building. You want a cash account to show how much you paid out of pocket. And then you want a mortgage, principal loan liability account to track how much you still owe on the building, okay? Or vehicle or sound equipment, whatever you finance. So there's the liability. For the expense side of things, you'll need a depreciation expense account, and you'll also need a loss on disposal expense account. Loss on disposal means that if the item was sold for less than its book value. So let's say I've depreciated $10,000 of my $25,000 car, so it's got a book value of $15,000, and I sell it for $10,000. Well, I just took a hit. It was worth $15,000 on my books, but I sold it for 10. So my loss on disposal or loss on sale of a fixed asset expense account says that I basically ate the cost of $5,000 of the car. The flip side of that is the income. You'll also want a gain on sale account as well. So to use the same example, $25,000 car, $10,000 accumulated depreciation, which means $15,000 net book value. So what if I sold it for $20,000? Well, that covered the entire kind of net worth of the asset, and it's a $5,000 additional gain of income. So there's where you use your gain on sale income account. So if you're tracking fixed assets in any regard for anything, I would suggest at least setting up this kind of medley of accounts just to have available. So what does a purchase of a fixed asset look like? Fair warning, I did not do a full screen on this keynote before launching it, so the graphics here are a little blurry, so apologies there, but hopefully you can see enough. If not, I can send up follow-ups later on. But so in a journal entry fashion, what does the purchase of a fixed asset look like? Okay, let's say you're paying with just cash, just 100% cash. On October 18th, today, we're going to buy a car. So I am going to credit my cash account for $25,000, since that's how much I'm paying out of pocket for this vehicle. So that is leaving my cash account, therefore it's a credit. I am adding value to my balance sheet through the vehicle fixed asset account for the same value of $25,000. So the journal entry here is between the vehicle fixed asset account that I have created and my cash. So debit the vehicle, credit cash. Alternatively, and probably a more real life situation, is what happens if you paid a little bit out of pocket, but then financed the rest on a loan. That would look like the second example here. So same date, I bought same car, but this time the full value is again being added to my books through the asset account. So there's $25,000 increasing or debiting my vehicle asset account. On the credit side, I'm paying $5,000 worth of cash out. So it's leaving my cash account, therefore it's a credit. And then the remaining credit there to get things to balance is a positive loan value of $20,000. So what this journal entry is essentially stating is I bought a $25,000 car, I paid $5,000 out of pocket, and now we owe a $20,000 loan to whatever company we took the loan through. Okay, so that's what a purchase of a fixed asset looks like. So then the depreciation kicks in. So at the end of the period, so on a monthly basis, what I'm going to do is I'm going to now spread the cost of that vehicle out over 5 years or whatever the schedule was, and that comes down to say a $416.67 monthly depreciation that I'm going to post for that vehicle. So per month, you're going to post an entry that is between the depreciation expense and the accumulated depreciation. Okay, so let me just explain the depreciation expense a little bit more. So again, the whole idea of a fixed asset here is spreading the cost of an item out over multiple periods. So on an annual or monthly basis, you're going to post depreciation, which is the total value of that asset, but divided by a certain number of years, spread out over those years evenly. So that's where depreciation expense comes in. So instead of counting the whole thing as an expense in 1 month, you're using depreciation expense to spread it out over multiple periods. So at the end of December, I'm going to post my monthly depreciation for $416.67. So that is a debit to the expense account, which increases your expense accounts, right? So there's depreciation expense debit. And then the credit side is accumulated depreciation, which is an asset account. So anybody that's thinking through the debits and credits and how certain accounts are increased and decreased, you'll know that asset accounts are typically increased by debits and decreased by credits. Well, accumulated depreciation is tracked as a negative asset. So that means that the credit to the accumulated depreciation will create and maintain a negative value, a negative asset or contra asset value on my balance sheet, which then looks like this on my balance sheet. So let's say at the end of the year, I've got $2,000 worth of cash, and I just put that in there to show you something else on the balance sheet. My vehicle fixed asset is $25,000. So the asset value on your books for the fixed asset doesn't change. It's the net that changes, right? So vehicle is still worth $25,000, but I have accumulated depreciation of $1250.01, which is 3 months, October, November, December of the 416. Okay, so my accumulated depreciation is negative $1250.01. My vehicle fixed asset is $25,000, cash $2,000. So my net total assets is the sum of all that. $2,000 plus $25,000 is $27,000 minus $1250.01, which brings me to $25,749.99. Gain or loss on disposal. We talked about this a couple of minutes ago, but I'll go over it here real quickly. Gain or loss on disposal, again, is if an asset sells for a higher value than its net book value. Okay, so my net book value in this previous example here, $25,000, accumulated depreciation is $1250, so I'm somewhere in the $23,000 balance for my car, something like that. Well, I guess it's $23,749. Anyways, so what happens if you sold this vehicle for then $30,000? Well, the gain on that is going to be anything over the net book value for the fixed asset. So if the asset sells higher than its book value, when you dispose of an asset, no matter if it's a gain or a loss, all of the accumulated depreciation is removed along with the asset value on the books. So essentially what you do is you post a journal entry to remove the value of the asset. You put a positive value into the accumulated depreciation as a debit, so that offsets. And then whatever difference there, if there's a difference there, then it's either a gain or a loss. So that's where the income would come into play. Gain is recorded to the gain on disposal income account, which you set up earlier. A loss is the opposite. If an asset sells for a lower value than its net book value, so if I sold this car for $20,000, well, my net book value is $23,000 and change. And if I sold it for $20,000, then I just ate the cost of the remaining to get up to my book value. Also, if an asset is lost or stolen, it's like you sold it for nothing, right? So there is no cash. You didn't get anything from it. It's just removed from your books. So let's say if this vehicle was stolen, I remove the value of the asset completely. I reverse the accumulated depreciation, and then the difference there, so that the $23,749.99, that is going to be counted as a total just 100% loss on my income statement for that period because the asset was stolen. Okay. And again, once you meet a gain or a loss, whenever this happens on a fixed asset, you stop depreciating the asset. Okay. So that is a ton of information on fixed assets. And quite honestly, this is one of the areas of accounting that is more complicated than just normal bookkeeping. So hopefully that this was helpful, but essentially everything we talked about here today and even more can be helped if you have a good fixed asset software. So the benefits of a fixed asset software is it hopefully streamlines all of everything we just talked about. So it'll automatically apply monthly depreciation over the lifespan of the item. So you'd go into a fixed asset software and you'd say, I bought a car or vehicle for $25,000 and I want to depreciate that over 5 years and I want no salvage value and I want to start depreciating this month. So what it'll do is it'll say, okay, great. So you're using straight line over 5 years. So here's the division. Here's how it goes to the monthly. So here are the monthly postings you need to do. So all you need to do is click post, and that's it. So that will post the entry. That'll keep the assets and the income statement up to date with the correct postings. So it completely streamlines the entire process. It's also easier to track a large volume of assets. If you are managing your fixed assets on pen and paper or an Excel spreadsheet, good luck. If you've got one or two, it might not be that difficult. But if you have, a lot of vehicles, or if you have multiple campuses and buildings and sound equipment and all kinds of stuff, having some sort of software that is geared towards making this part of your life easier will definitely help. So it's going to make tracking large volumes of assets a ton easier. It also reduces errors or missed journal entries. So to use my example earlier, if you keyed in, here's the vehicle, here's the total value, here's the life cycle, go, then it'll do the calculations. It'll post it for you sometimes, or do the depreciation to where all you have to do is just click a post button. It reduces the errors so that if you're doing this by hand or if you're doing this in a spreadsheet, it kind of removes you or the user from the equation, where it just relies completely on the computer. So there's no kind of missed formula or wrong summing total, or you forgot to do a month or something like that. It just kind of removes the human error side of things. So it's definitely a benefit. So now it's time for me to explain not only the benefits of a fixed asset software, but shamelessly plug how we can do this with Aplos. So we can take care of those three categories for you as well. So we automatically apply the monthly depreciation over the lifespan of the item. We allow you to track large volumes of assets, so that makes your life easier there. And just having things in a software reduces errors or missed journal entries. Plus, we allow for you to set custom asset names and unique identifiers. So if you have, fleet vehicles, you've got 15 vehicles, and you want to track each one by its own kind of unique, code of symbols and characters, you can do that. You can also just put a custom name, so you can call it the Toyota, vehicle, anything you want to call it. We'll also automatically create the journal entry that needs to be posted. So you put in the amount, the lifespan, and we say, great, come back and once a month and just click post. So we automatically create the journal entry. You just click post. That posts into your accounting, which then puts it into the accumulated depreciation, decreases your net value on the balance sheet. It also puts it onto your income statement, so your income statement sees it. And then even if you did a disposal of a fixed asset, either a gain or a loss, it's just a click of a button. You don't need to calculate anything. You don't need to input any sort of journal entry. All you do is go in and say, I'm disposing this asset on this date, for this reason, and here is how much I sold it for, and then we do the entry for you. And you can also filter access into diving into one group of fixed assets. That meant it's supposed to say fixed assets, not fixes assets. So if you wanted to show, the screen and say, show me all of my buildings, or show me all of my vehicles or equipment or whatever custom thing you set up, it's really easy to filter that screen and only manage the type of asset that you're needing to look at that one time. Plus much, much more. So that is Aplos fixed assets. So that brings us to kind of conclusion / Q&A. And this is actually my favorite time of the webinar because it allows you guys to kind of digest all of the word dump that I just threw at you on fixed assets, and allows you to kind of formulate questions and ask me, and I will do my best to answer everything that you've got. Fair warning, this subject, again, is a little bit more complicated and gets into other areas of accounting like taxes and the right, quote unquote, way to do things per governing authorities, GAAP or IRS or what have you. If there's a question that we are just unfamiliar with or uncomfortable kind of speaking into because we're not CPAs, we're just accounting software, then I will definitely disclaim that and try to give you an access to a resource that might be able to help you. But I'll do my best to answer everything for you here right now. Also, if you guys wanted to see an example of the fixed assets in Aplos, I'd be more than happy to show you that as well. Yeah, so let's first go through your questions here real quick. Let's see. First one here. This is always the first question that I see, which is, yes, this is being recorded and will be available at another time. So if you came late or if you want to watch it again or share it with someone, this is being recorded, and sometime maybe today or tomorrow, it will be put onto YouTube, and we'll have the link and we'll send that out to you when we've got it, so that way you can share it or watch it, whatever you'd like to do. Also, the presentation slides, sure, we can also get those to you as well. If you're interested in that, just send us an email and we'll get that to you. All right. Okay, so first question here, are churches required to depreciate fixed assets? Man, right out of the gate, there's a good question that has some tax correlation. The point of depreciating fixed assets is so that you don't, you don't have a massive expense in one period. So you don't have to count a full $25,000 vehicle purchase in 1 year or even 1 month. So that helps you budget. So just from an operational standpoint for an organization, tracking fixed assets is very helpful because it allows you to spread cost out over multiple periods. That does have tax implication for businesses and even nonprofits. So for a church, you don't need to file any sort of tax return or anything. So I don't think, or I don't know of any benefit necessarily from a tax standpoint. But from an operational standpoint, definitely I think if you have fixed assets, if you have a building, if you have a vehicle, if you have assets or items that are large valued items, I would recommend doing fixed assets. Just to kind of keep things clean, and that way, if you never need to replace it, it's an accurate look at what your finances are. Plus, from another standpoint, if you ever need to apply for a loan or something, they're going to want to know what's your balance sheet. If you say, well, here's my balance sheet, and they say, is this everything? And you say, well, no, we actually have a building, we have a car, and we have equipment, we have all this different stuff. They're going to say, okay, well, why don't you figure out what your balance sheet is and then come back to us? So just from that standpoint too, just being well-rounded, budgeting correctly, and just kind of having an overall 30,000-foot view of your organization and all of its assets and values, I would definitely recommend tracking fixed assets. Hopefully that's helpful for you, Carl. What is the useful life you would recommend for air conditioner units? Another good question. For that one, for any sort of life cycle standard, I would always point back to either the IRS or to GAAP, GAAP, generally accepted accounting principles, for those categories. It seems to me that it would either fall into the category of a building improvement or some sort of equipment, maybe even an equipment standpoint. So you could probably get away with using one of those cycles, but I would double check that with one of those governing authorities just to make sure you have the right cycle. Is it okay to depreciate everything once at the end of the year? Yes and no. The only downside to that, Dorian, is essentially what you're doing by doing it at the end of the year is you're counting the full amount in 1 month, right? So depreciation expense it's an income statement line item. It's on your expenses, and that at the end of the year will be on your income statement. So if you wanted to show an income statement for 2016 total, it doesn't really matter what month you posted in. It's a total. So if you posted it all in December or evenly throughout each month, the total is going to be the same, so it doesn't really matter. But if you ever wanted to see an income statement by month, where you're showing your income and your expenses and your net income or net loss for each month side by side, then January through November is going to show, hopefully, profitable, 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 profitable all the way through. And then December, it's going to look like you took a big hit because you have a lot more expenses allocated to just 1 month in one category. So I think with that in mind, you could probably get away with doing it annually. I think overall, just the annual totals are typically what banks look at and financial reports really focus on. But for you, again, kind of operationally and budget wise, might be worth it to just do it monthly. So that way, if you ever needed to look at an income statement by month comparison, it's got that kind of even divvy throughout all of those months instead of all being lumped into one. So hopefully that makes sense. Which version of Aplos has the fixed asset capability? Good question. That is part of our total accounting. For those of you who are unfamiliar with Aplos and what we offer fund accounting for churches and nonprofits, which is specific to churches and nonprofits. That's the kind of accounting you need to keep track of. And we have multiple tiers of our software. So we have kind of a starter package, which includes the fund accounting, reporting, budgeting, and some bells and whistles. We also have standard, which has all of starter plus contributions management. So if you need to track accounting and donations, so how much people gave to you and giving them contribution statements, that's standard. And then we have advanced, and advanced varies in price depending on what you need. So fixed assets is part of advanced or part of total accounting. And if you're curious in that, what I would recommend is either going to our website, just aplos.com, and watching a demo or doing some sort of contact form so a salesperson can work with you and find out what level of accounting you need to be in. But advanced is where that sits. Let's see, is the ability to track fixed assets included in the basic package? No, that is part of the advanced. So that, again, I would recommend contacting us or send me an email and I'll put you in touch with a salesperson, and they can walk through what you need and what the cost of that would be for you. How do you suggest a church build the initial cost of the original building when you're not sure you have all the receipts? Church build the initial cost of the original building. So, Joy, if I'm reading this right, it means that you guys bought your building, or built your building. So you had land and you collected the funds and you laid the foundation, put up the walls and everything. If that's the case, even the total sum of the receipts might not even be necessarily the worth of the building. I'm unfamiliar with what it means to build a building. I've never done it, never been a part of it. But I know that when you buy a building, there's some sort of appraisal process. So, and from what I've heard, I think that's a part of building a building as well. So you put all the pieces together, and then it gets appraised for what it's valued at, right? The appraisal is what I would record as the building value. So if you have an appraisal value, I would put that in there. If you don't, it's a good question. I would ask a CPA just to make sure of that, because I think that just summing the receipts might not even be indicative of the true value of the building. So I would run that by an accounting professional. But if there's an appraisal value, then I would run with that. Let's see, can the application use useful life of the assets to budget for capital replacement? We don't have any sort of capital replacement necessarily built into fixed assets. What we track is what's the value, what's the depreciation, and what's the net book value. So the useful life is typically what you're depreciating it out over. But we don't have any sort of replacement budgeting or module there, Becky. Yeah. Do you have the slides in PDF format? Not currently, but that's easy to do. Which I think we'd probably share it either in PDF, or this is a Mac program, which I'm assuming 90% of you don't have. But we can also convert this to a PowerPoint as well. So if PDF works better for you, or if you have PowerPoint, either one of those is possible for us. Is this an add-on module to Aplos or a separate system? It is. It's not necessarily a module. It's just part of a different tier, right? So if you are currently using starter or standard, it's part of the advanced, which is just, let me get back there, just another tier. So that comes with a number of other things too. So in the advanced, we have We have allocations. So if you wanted to track or be able to post, an income or an expense transaction that kind of spreads out over multiple funds or tags or accounts, you can set up an allocation that does that. It also has budgeting by fund, multiple levels of tags, so you can track projects, departments, fundraisers, reoccurring transactions, lots of stuff. So there's a ton of features in our advanced product, which a salesperson can definitely help you with. Let's see. If an asset has been fully depreciated, why not remove it from the fixed assets list? Good point. And you can. If it has zero value, there's kind of no point. But if you wanted to see it almost as a possession list, so let's say you had 5 cars that you bought 10 years ago. They're done. You still own the cars, but they're done. They're done being depreciated. Their cost is already spread out. Their net book value is 0. On your balance sheet, they could still be listed and they will be offset by the accumulated depreciation. So really it's kind of no harm, no foul. They're not adding any value numerically to your balance sheet. So they're kind of pointless at that point, but you might want to show them just for all bases, checked kind of a thing. So if someone asks you, do you have any fixed assets? And you say, well, no. But then they look at the car that you own. They might wonder whether or not that's true. It also doesn't mean that you can't sell it for anything, right? So your book value might be 0, but you could definitely sell it for maybe $1,000 or something. So at that point, you would remove it from your books and record the gain. So as a practice, I would say if you've got it, leave it. Or decommission it. If you're going to throw it away or donate it or something or get rid of it, then you can dispose it. If it's still in your possession, though, even if it's been fully depreciated, might not be the worst thing to just keep it on your balance sheet. We are a smaller church with basic sound equipment and the computers on our fixed asset list. I depreciate at the end of the year, not monthly. Is there a reason legally to depreciate monthly versus yearly? I covered that a little bit ago, Lydia. Let me know if you still have a question on that. I'd be happy to work through it. Are there any issues with expensing facilities improvements? Let's see. Are there any issues with expensing facilities improvement projects versus capitalizing them? Our projects are more difficult to track across time. Good question. Our kind of focus here is primarily on the depreciation side of things, not necessarily a capitalization. So I would run that through a CPA just to make sure that they kind of understand the situation in full and can kind of recommend the right way to handle that, Dan. Let's see. We track all computers purchased to help with completing our 571-L filing for county tax exemption. Okay. Let's see. I'm not sure that I see a question earlier there. Sue, let me know if I'm missing something there or if you have a question. But yep. Let's see, Laura. What if you're wanting to start with current fixed assets that have been purchased in the past and have not been tracked prior? Yeah, good question. So if you're coming in late, let's say you bought a car, but you weren't really tracking it, but now you're starting Aplos or another system, and you want to pick up and you want to start doing this. What you want to do is figure out what would have been the total depreciation over the last some odd years. So if, again, just to run with the same example always, if there's a $25,000 vehicle that you bought 2 years ago and you're just now starting depreciation tracking, fixed assets tracking, well, in a normal life cycle of a vehicle, you're going to depreciate it over 5 years. So if you're already 2 years deep, then you are now in year 3 of what would have been your depreciation cycle. So in Aplos, and I'm sure all other fixed asset modules do this, what we ask for when setting up a fixed asset is, have you already been depreciating this? And what you would tell us is, yeah, sure. I haven't been, but whatever. We have been. We want to do it. So what you'll tell us is, if there's 25,000 normally going over 5 years, it's $5,000 per year. You're already 2 years deep, so you're kind of your starting balance or your entry point here is $15,000 left to depreciate, right? So you would just have to do a little bit of manual calculation there, Laura, to figure out, okay, well, when did I purchase it? What was my effective date? What date is it now? So how much would have I been depreciating over this period of time? Is there any value left to depreciate? And if so, then that's where that picks up. kind of in the middle of the term. So yeah, let me know if that makes sense there, Laura. If we've never tracked assets before, where do we begin? Well, same kind of question. I would first kind of get the capitalization policy and depreciable life policy figured out. So as an organization, I would just take some time and think through, well, we've never tracked fixed assets, but maybe we should. Okay, well, what's our threshold? Well, I don't know. I mean, all of our purchases are, somewhere in the couple of hundreds. So maybe $15,000 is not, it's too high. Maybe you set your threshold at 1,500 or 2,000 or 3,000. So you meet that. So you set that threshold, and then you look at everything and you say, well, have we purchased anything for over 3,000 semi-recently or recently? If so, then that's where the depreciable life policy kicks in. So you kind of set the threshold, you see what meets the threshold. If anything does, then you have the depreciable life policy to say, okay, well, sound equipment, vehicle, and a camera meet that threshold. So now what are the terms? So this one is 3 years, this one's 5, this one's 7. So that's where you'd pick up with, okay, then when did we buy them? How much would it have been? So that kind of stuff. So it's definitely a process. There is kind of a number of things you'd need to think through to get that all set up. Christy, if you are interested in that and you want to use Aplos to track that, then I would still recommend meeting with or talking with one of our salespeople. They can kind of explore what the cost and what we need to do to get you started. But then once they're done and once you're set up with Aplos, then what we can do is actually take that and part of like an implementation service, we can get you and all of your information collected, so that way we can help kind of design the structure as well as get that put in for you. So that way it kind of puts you in at that middle spot. So we'll take care of the back calculations, the math, and say, okay, well, here's where you are currently, here's what you have left to do, and then it's all set up in the system. So really all you do is then log in on a monthly basis and click post, and that's it. Let's see. I just mentioned this a little bit, but yes, we do have some services here that can help with this. Our bookkeeping services are, we do have bookkeeping, so kind of monthly keeping up with your expenses and income and, doing your books for you. We definitely have a service there. But we also kind of have an implementation and migration service as well. So if you are new to Aplos, if you're coming in fresh and need some help, either bringing information over from a different accounting software or a spreadsheet or memory, anything that you're converting from, we can help with that. So if you're curious, let us know. Send me an email or send one of our sales reps, really anybody at Aplos, send somebody an email, and we can get you pointed to the right person so that we can help with that. All right. Let's see. Our land and building are paid off. If these things increase in value, what would be the accounting entry? You don't have to double check on that, Brenda. Essentially, if you've got a value there, you typically don't mess with the value very often. Like let's say you bought a building, like a house, right? Houses fluctuate in value pretty constantly, especially here in California. They fluctuate all the time. So if I bought a house for $200,000 and 5 years from now it's worth $250,000, well, I don't necessarily need to do anything on my books for that. Just kind of mentally knowing how old the building or the property is, you can kind of guesstimate what the value would be today, but you really wouldn't do anything on your books unless you had reason to, like you're refinancing or you're selling or you're merging with another organization. Like if let's say if there's an older church that is kind of ending its tenure and wants to merge with your church, and they own this building that they've had for 1,000 years, and they want to know, well, how much is it worth now? That's where that would be probably more useful, is if you're merging, you'd get kind of an updated value, right? So that your books have now kind of current information. But if it's just on a whim or every couple of years, I wouldn't even mess with it. I just leave it whatever its purchase value was. Only if you're selling it, merging, disposing of it, or refinancing would I research on what the change of value is. Now, that being said, the accounting entry is pretty straightforward. What you'd do is if it raised in value, you'd most likely post an entry between the asset and the equity account of the fund where that value sits, or vice versa if it decreased. we have a couple more minutes here, but hopefully I'll get through these last few questions here. Can you just get the fixed asset application even if you don't have the accounting? Unfortunately, not. The fixed asset is a part of our accounting, so there's no way to kind of piece that off. But if you have accounting already in another system, again, we can help you move from that system to ours and help you get kind of migrated over fully. So it's not just a, well, here you go, talk to you later. It's a handheld, like integrated process. So we would take you from what you're currently using, move you to Aplos, make sure that you're acclimated, everything makes sense, and you're trained going forward, plus being able to offer the fixed asset stuff. Okay. Yeah, a couple of just repeat questions. Yes, you can kind of come in midstream with tracking fixed assets if you haven't been doing it for a while, but you want to start. Totally possible, and we can help with that. And then also, if you have a starter or standard package with Aplos, it does not include fixed assets, but the advanced does, and a sales representative can certainly help figure out what that would mean for you. Let's see. Oh, interesting, Brenda, that I would that I would bring in that exact merger example. Yeah. So yeah, in your case of a merger there, oops, where'd you go? There we go. We've merged with another congregation. Their land and building are paid off. How I record that in the books? Is it a fixed asset that needs to be depreciated? And or if it actually increases the value, what would that accounting entry look like? Yeah, if you merged and it's already been fully depreciated, it's fully depreciated. You don't owe anything, right? So unless you bought it from them, then that's where you would probably want to depreciate it. But if it's nothing, if it's just now your asset from the merger, then I would just leave it. If in that process there needed to be a different kind of if there was an appraisal, if there was an updated value for the land or the building, then I would put that in as the value. But if there was no appraisal process, if it's just on their books, it's $100,000 for land and $200,000 for the building, then I would just leave it what it is. Now, you can certainly double check that with a CPA. They might tell you something different, but from an accounting standpoint, I don't know of a reason why you would need to change the value unless you're either selling it, taking out a new loan to purchase it, or getting it appraised for another reason. So great. Well, that is all of the questions that I currently see, which is fantastic. I was a little worried we weren't going to get through stuff, but if you guys have other questions, or if there's a subject or anything you wanted to learn more about, feel free to follow up with us. We will be sending an email out here in the next day or two with the link to this recorded version, as well as some sort of either PowerPoint or PDF version of these slides. And so feel free to respond to that if you have any further questions, and they can get you pointed to me or whoever can answer that. And if you're interested in Aplos and or the fixed asset module of Aplos, let us know that as well. We've got a team of salespeople that would be more than happy to spend time with you, hear what you need to do, recommend the right level of our software, and then work through the implementation, the migration, the setup, the training, all of this or different stuff. We can help with that. So certainly reach out to us, and we can get you situated. So awesome. Well, thank you everyone for spending time with me today. I know that this subject is, again, not the easiest in the world, but hopefully the information was helpful. And if you have anything else that you want to work through, just let us know, and we'd be happy to help. All right. Talk to you soon. Thank you.